Talking about expensive things, how can we not mention the iPhone? It is at the center of the US-China tensions now.
For decades, Western companies such as Apple and McDonald's have made a fortune out of patronizing Chinese consumers, but it doesn't mean there is without the emergence of rising brands and markets. These monster companies aren't the only ones on top now, and with Trump imposing tariffs on everything, some US companies might stop losing their grip on China's market the soonest. The fall. In recent years, it's become increasingly clear that companies like McDonald's and Apple are facing major challenges in China, a market once considered a goldmine for growth and profit. For both brands, China was once seen as a place where expanding business operations could lead to huge rewards. But now, things have shifted, and the dream of easily making a fortune in China seems less certain. Both McDonald's and Apple initially found success in China because they were offering something new and unique. McDonald's brought the concept of fast food to China, while Apple's products offered a sleek, premium option in a market that was eager for high-quality electronics. However, over time, local companies have stepped up to the plate, offering competitive products at lower prices. For McDonald's, local chains like Daikos and KFC, owned by Yum China, have aggressively expanded, offering similar fast food options while also incorporating local tastes. McDonald's, on the other hand, has struggled to fully adapt its menu and experience to Chinese preferences. As a result, it has had to revamp its strategies in the face of growing competition. Similarly, Apple faces stiff competition from Chinese brands, which offer high-quality smartphones at more affordable prices. Apple's premium pricing model, which once attracted middle-class consumers, is now a tough sell in a market where consumers are becoming more price-sensitive and value-conscious. Plus, the trade tensions between China and the US have made Apple's reliance on Chinese manufacturing and supply chains more complex. Consumer preferences in China are evolving rapidly. The younger generations, who are becoming the dominant consumer group, are very tech-savvy and more value-driven. They are looking for products and experiences that align with their local identity and cultural values, and many of them are less loyal to foreign brands than previous generations. For McDonald's, this has meant that consumers are seeking out food that feels more authentically Chinese. The company has tried to integrate local flavors and ingredients into its menu, but it still faces the challenge of competing with local eateries that offer fast, affordable, and culturally relevant food options. The rise of food delivery apps and an increasing appetite for healthier eating have also hurt McDonald's traditional business model, which focuses on large, fast meals. For Apple, Chinese consumers have become more focused on technology that meets their everyday needs at a lower cost. Apple's products are seen as aspirational, but not always practical when compared to the highly functional and cost-effective offerings from brands like Huawei, which also integrate local apps and services that are more appealing to Chinese consumers. This shift in preferences means Apple must work harder to maintain its luxury status in a country where local brands are catching up quickly. China's rapid economic growth has slowed down in recent years. While the country is still a major global player, the days of double-digit growth are behind it. As the economy slows, so does consumer spending. This slowdown, coupled with rising costs of doing business in China, has hit both McDonald's and Apple. For McDonald's, rising labor and food costs, along with the need for constant innovation to remain relevant, have squeezed its profit margins. Apple, too, has felt the effects of an economic slowdown, as the purchasing power of Chinese consumers weakens, making it harder to sell premium-priced products. Moreover, the global supply chain disruptions caused by the COVID-19 pandemic and ongoing trade tensions between the US and China have made it difficult for companies to source materials and products at the low costs they once enjoyed. Apple, especially, is highly dependent on Chinese factories for production, and disruptions have only added to its costs. The Chinese government has been promoting the idea of self-reliance in technology and food, and this has meant that local businesses are benefiting from government support. In the tech space, China is pushing for its own homegrown alternatives to US products. This is not just about creating competitive products. It's about reducing reliance on foreign companies. This push has created a more hostile environment for Apple, as Chinese consumers and the government seem increasingly less interested in buying American products. McDonald's, similarly, has faced pressure from local governments and competitors to adhere more to Chinese tastes and values.
McDonald's is one of the world's largest restaurant chains, and it is about to get even bigger.
While McDonald's has worked hard to localize its menu, there's still a sense that foreign brands are outsiders, and that's led to a growing distrust of Western companies in some circles. The combination of fierce local competition, shifting consumer preferences, geopolitical tensions, rising costs, and a slowing economy has made China a much tougher market for McDonald's and Apple. While both companies are still influential in the country, they can no longer bet on making a fortune like they once did. To continue thriving in China, they'll need to adapt more strategically, understand the evolving needs of Chinese consumers, and navigate the complex political landscape. For now, the dream of easy profits in China may have to be reconsidered. Do you agree? Geopolitical tensions. In recent years, the geopolitical tensions between the US and China have significantly affected the operations and prospects of major American companies in China, particularly Apple and McDonald's. Both of these global giants, once poised for substantial growth in the Chinese market, are now facing increasing challenges due to the evolving political and economic climate.
The growth potential in China is absolutely massive. There's definitely a massive opportunity for growth and really their key priority market.
While Apple faces direct scrutiny and strategic hurdles from the Chinese government, McDonald's is grappling with a more subtle but still impactful set of challenges, including rising nationalism and a shifting regulatory landscape. Furthermore, the trade policies enacted by the US, particularly under the Trump administration, have only complicated matters for both companies, especially in the context of tariffs and economic retaliation. Apple, a company that once thrived in China due to its status as a premium technology brand, has faced increasing pressure from the Chinese government as part of the broader geopolitical rivalry between the US and China. As China continues to promote its Made in China initiative, aiming to build a self-sufficient economy, Apple's reliance on Chinese manufacturing has come under scrutiny. The Chinese government has expressed a preference for local technology companies, pushing for homegrown alternatives to US products, particularly in the tech sector. One significant development that exemplifies this trend occurred in 2020, when the Chinese government issued a ban on government employees using Apple's iPhones. This move was part of a broader push for local alternatives, such as Huawei and Xiaomi, both of which have gained significant traction in the domestic market. The government's promotion of Chinese-made devices is a clear attempt to reduce dependency on foreign tech products, particularly from the US, amidst rising tensions with Washington. In addition to this, Apple has faced growing obstacles as the Chinese market increasingly favors domestic tech companies.
It's the best performing mega cap stock over the past 1 month, even though you could make the case that it has the most to lose.
The Chinese government has also enacted laws that require foreign companies to store data within the country and share certain aspects of their technology, which places Apple in a difficult position regarding its privacy policies and business model. These regulations can create vulnerabilities for Apple, as the company must weigh the need to comply with local laws against its commitment to protecting user privacy. In some instances, Apple has been forced to comply with Chinese laws, which has led to criticism from Western observers concerned about the company's ethical stance. Moreover, the broader political tensions between the US and China, particularly under the Trump administration, have created an environment of economic unpredictability. The imposition of tariffs on Chinese-made products, particularly in 2018, led to increased costs for Apple's manufacturing processes in China. The ongoing trade war and retaliatory tariffs have further complicated Apple's supply chain, making it harder for the company to maintain its cost-efficient model. With tariffs on certain Chinese imports, Apple was faced with the difficult choice of either absorbing the increased costs or passing them on to consumers, potentially pricing its products out of the market. While McDonald's does not face the same level of direct scrutiny as Apple, the geopolitical tensions between the US and China have still made it harder for the fast food giant to thrive in the Chinese market. One of the key challenges McDonald's faces is the rising anti-Western sentiment in some parts of Chinese society. As national pride grows and a sense of cultural identity strengthens, local consumers have become increasingly hesitant to embrace foreign brands.
With an eye towards slashing operating costs, McDonald's sold its China business for a little over $2 billion in 2017.
Especially those perceived as symbols of Western imperialism or influence. This shift in consumer sentiment has prompted McDonald's to adjust its strategies in China. Once seen as a symbol of convenience and modernity, McDonald's has had to retool its menu and marketing to cater more to local tastes. While McDonald's has been successful in incorporating Chinese ingredients and flavors, it is still competing against local brands that are often more deeply ingrained in Chinese culture. Brands like DCOS, KFC, operating under Yum China, and local fast food chains have stepped up their game, offering affordable and culturally relevant meals that are challenging McDonald's dominance. Moreover, the Chinese government has made it increasingly difficult for foreign companies like McDonald's to operate without facing scrutiny. The rise of stringent regulations on food safety, environmental standards, and business operations has created an added layer of complexity for Western companies. McDonald's has had to navigate through these regulations, adjusting its operations to comply with Chinese laws. While this is part of doing business in any country, it's become a particularly complicated process in China due to the fast-changing nature of regulations and the unpredictability of government oversight. The Chinese government has also imposed new rules requiring foreign companies to enter into joint ventures with local businesses, giving local entities a stake in foreign operations. This policy is designed to ensure that foreign companies contribute to the Chinese economy, but can also lead to tensions if the interests of the foreign companies clash with those of their local partners. For McDonald's, this has meant navigating complex partnerships with Chinese firms, balancing the need for growth with the need to adapt to China's changing regulatory landscape. The trade policies of the Trump administration, particularly in relation to tariffs on Chinese goods, have had a profound impact on both Apple and McDonald's. In 2018, the US imposed tariffs on approximately $250 billion worth of Chinese imports, including electronics and consumer goods. For Apple, this meant higher manufacturing costs, as many of its products are assembled in China. Apple has been vocal about the impact of these tariffs, with CEO Tim Cook urging the US government to reconsider the imposition of tariffs on Chinese-made goods. Although Apple has tried to shift some production to other countries like India and Vietnam, the cost of production and the complexity of managing a global supply chain have made it difficult to fully avoid the impact of these tariffs.
Very good afternoon to you. China has announced it will introduce 34% retaliatory tariffs on all goods from the United States.
For McDonald's, the Trump administration's tariffs have also led to higher costs for ingredients, packaging, and other materials sourced from China. While McDonald's has not been as vocal about the impact of tariffs, the rising costs have forced the company to reassess its pricing strategies in China. The company has had to balance the need to remain competitive in a price-sensitive market while coping with the added financial burden of tariffs. The ongoing geopolitical tensions between the US and China, coupled with the US tariff policies, have created a challenging environment for both Apple and McDonald's. These companies must not only navigate the political complexities of operating in China, but also adapt to an increasingly competitive and nationalistic marketplace. With the economic and political climate uncertain, both Apple and McDonald's face significant obstacles in maintaining their profitability and market position in China. The geopolitical tensions between the US and China have made it increasingly difficult for companies like Apple and McDonald's to rely on China as a primary source of growth and profit. Apple has faced heightened scrutiny from the Chinese government and pressure to adapt to local regulatory demands, while McDonald's must contend with rising nationalism and a more challenging regulatory environment. the Trump administration's tariff policies.
We begin the day with Trump's tariff threats and the political consequences.
Have only exacerbated the situation, increasing costs for both companies and complicating their operations in China. As the geopolitical landscape continues to shift, Apple and McDonald's must carefully navigate these challenges in order to remain competitive in one of the world's largest and most dynamic markets. Do you think it will lose billions of worth once they lose China? Share your thoughts in the section below. Also, if you're an Apple user or not. If you're not, why? Local brands over Apple. Undeniably, Apple has been a dominant player in the Chinese smartphone market, celebrated for its premium design, user-friendly interface, and innovative technology.
Beautiful titanium design, our most innovative camera system.
However, in recent years, Apple has found itself facing growing competition from both domestic and international brands in China. Despite its strong brand recognition and loyal global customer base, Apple has been losing market share to local Chinese companies. This shift can be attributed to several key factors, including rising local competition, price sensitivity, cultural preferences, and the Chinese government's push for domestic brands. As Chinese consumers increasingly choose other quality brands over Apple, it becomes crucial to understand the various elements contributing to this trend. One of the most significant reasons why Chinese consumers are gravitating toward alternative smartphone brands is the rise of local competitors such as Huawei, Xiaomi, Oppo, and Vivo. These companies have successfully capitalized on the growing demand for affordable yet high-quality smartphones that meet the specific needs of Chinese consumers. Huawei, in particular, has been a major challenger to Apple's dominance in China. With its strong focus on innovation, cutting-edge technology, and the development of proprietary features like the Kirin chipsets and Leica camera lenses, Huawei has built a strong reputation for producing high-performance smartphones. Many Chinese consumers view Huawei as a symbol of national pride, particularly amid the ongoing US-China trade tensions.
At the end, if not this year, then in a decade, of most US-China trade,
which have led to Huawei's further promotion as a domestic alternative to Apple. Xiaomi has also emerged as a formidable competitor, known for its budget-friendly yet feature-packed smartphones. Offering impressive hardware specifications at a fraction of the price of Apple's iPhones, Xiaomi appeals to cost-conscious consumers who prioritize value for money without compromising on quality. Oppo and Vivo, two other Chinese smartphone manufacturers, have also seen tremendous success in the market, catering to different segments of the population. Oppo focuses on innovative camera technology and design aesthetics, while Vivo positions itself as a brand that blends technology with entertainment, particularly appealing to younger, tech-savvy users. These local competitors have not only matched Apple's technological capabilities, but, in many instances, exceeded them in certain areas, such as camera quality, battery life, and charging speed. For example, Huawei's flagship models have frequently been equipped with cutting-edge camera technology, including impressive zoom capabilities and AI-driven photo enhancements, which have made them particularly appealing to photography enthusiasts. As these brands continue to innovate and capture the attention of Chinese consumers, they pose a significant challenge to Apple's market share in China. Price sensitivity plays a crucial role in Chinese consumers' preference for local brands over Apple. While Apple's products are synonymous with premium pricing,
base iPhone 16 may cost over $1,000. Because of tariffs and a whole bunch of political factors,
many Chinese consumers are unwilling to pay a premium for a smartphone, especially given the rapidly growing array of quality alternatives available at more affordable prices. Apple's flagship iPhones can be prohibitively expensive for many potential customers, especially when compared to the cost of comparable models from Chinese brands. For instance, Huawei's P series and Xiaomi's Mi series smartphones offer similar, if not better, specifications and features at a significantly lower price point. Consumers in China, where competition in the smartphone market is fierce, have become accustomed to finding high-performance devices at lower prices. These brands are able to offer cutting-edge features like large, high-definition displays, advanced camera systems, and fast charging, all at a price that makes Apple's iPhones appear overpriced by comparison. In contrast to Apple's strategy of maintaining a high-end premium image, Chinese brands have successfully adopted a pricing strategy that prioritizes affordability without sacrificing quality. As a result, for a significant portion of the population, the decision to opt for a local brand is driven primarily by the desire to get the best value for their money. Another important factor that influences Chinese consumers' preference for local brands is national pride and the desire to support domestic companies. Apple, despite its global status, is often seen as an American brand. And as geopolitical tensions between the US and China have escalated in recent years, there has been a growing sentiment among some Chinese consumers to support homegrown companies. This shift is particularly noticeable with Huawei, which has become a symbol of technological advancement and innovation in China. The Chinese government has also been actively promoting domestic brands, especially in the context of the Made in China 2025 initiative, which seeks to boost China's technological self-sufficiency. As part of this nationalistic push, Huawei, Xiaomi, Oppo, and Vivo have benefited from favorable policies, including government support for research and development and subsidies for innovation. These policies have helped create an environment where domestic companies not only compete with international brands, but are also seen as national champions. For many consumers, purchasing a Huawei or Xiaomi smartphone feels like a patriotic act, further strengthening the appeal of local brands. Furthermore, Chinese brands are increasingly tailored to the specific needs and preferences of the Chinese market. For example, many Chinese smartphones come preloaded with domestic apps and services such as WeChat, Alipay, and Baidu, which are integral to the daily lives of Chinese consumers. Apple's iPhones, while capable of supporting these apps, often do not integrate them as seamlessly as local alternatives. This added level of convenience and customization makes local brands more attractive to consumers who value a personalized and locally relevant user experience. The Chinese government's policies and regulations have also played a role in steering consumers away from Apple in favor of local brands. Over the years, China has increasingly taken a hard stance on foreign tech companies, implementing a range of policies that encourage the use of domestic alternatives. For example, in 2020, the Chinese government banned the use of iPhones by government employees, citing security concerns related to foreign technology. This move was part of a broader push to reduce dependency on Western tech companies, and it had a ripple effect on Chinese consumers' perceptions of Apple. The government's actions have reinforced the idea that local brands are more secure and better aligned with China's long-term technological goals. Moreover, China's push for data sovereignty has raised concerns about the privacy and security of foreign tech products, particularly those manufactured by companies like Apple. Apple's compliance with Chinese data regulations, including the relocation of Chinese iCloud data to local servers, has been met with criticism from privacy advocates. For many Chinese consumers, the perception that Apple might be more susceptible to foreign influence or surveillance has further fueled the shift toward local brands, which are seen as more reliable and secure. The decision by many Chinese consumers to choose other quality brands over Apple is driven by a combination of factors, including the rise of competitive local alternatives, price sensitivity, national pride, and the influence of government policies. Companies like Huawei, Xiaomi, Oppo, and Vivo have made significant strides in offering high-quality smartphones that cater to the needs and preferences of Chinese consumers at more affordable prices than Apple. At the same time, the growing sentiment of national pride and the Chinese government's push for technological self-sufficiency have made local brands more appealing to consumers who view supporting domestic companies as both a practical and patriotic choice. As China continues to prioritize its own technological advancement, Apple will likely face ongoing challenges in maintaining its market share in the country. While the company's brand remains synonymous with premium quality, it is increasingly evident that Chinese consumers are finding more value in the innovative, cost-effective alternatives offered by local smartphone manufacturers. This shift reflects not only the changing dynamics of the smartphone market, but also the broader political and economic landscape that is reshaping the relationship between China and foreign brands. The underrated duo, McDonald's and China. If China were to stop patronizing McDonald's, the ripple effects would be felt far beyond the fast food chain itself. McDonald's, with its vast global reach, relies on markets around the world for substantial portions of its revenue, and China, being one of its largest markets, plays a critical role in that equation. Given China's immense size and growing middle class, the financial impact on McDonald's and the global economy as a whole could be quite significant. McDonald's has been operating in China for over 2 decades and has built a solid customer base, becoming a prominent player in the fast food industry there. With over 3,500 locations across the country, China is one of McDonald's biggest markets, accounting for a significant portion of its revenue. For McDonald's, China represents a fast-growing market with a young, urban population that's increasingly adopting a Western style of eating out. This demographic, particularly in urban areas, is a key driver of McDonald's revenue in the region. If China were to stop patronizing McDonald's, it would cut off a significant chunk of that revenue, potentially pushing the company to make up for the losses elsewhere. McDonald's isn't just a restaurant chain, it's also a symbol of American global capitalism. Any reduction in McDonald's operations in China would send shockwaves through the global economy, especially considering China's critical role in global trade and economic growth. The first and most obvious effect would be on McDonald's revenues. The company has seen rapid expansion in China, and a large portion of its global growth has come from this market. According to reports, McDonald's earnings from China represent a healthy chunk of its overall revenue, especially since the company has been focusing on the Asian market as a growth opportunity. If McDonald's loses access to the Chinese market, not only would its revenue take a hit, but it could also face difficulties in meeting its global profit targets. McDonald's has already been working to reposition itself globally with new menu items and marketing strategies. Losing China, one of the world's largest consumer markets, would force McDonald's to rework its global strategy. The company would need to compensate for that loss by increasing its market share in other regions, which would not be easy, given the already saturated fast food markets in places like North America and Europe. Beyond McDonald's revenue loss, there's also the broader impact on global supply chains. McDonald's sources a large portion of its products from international suppliers, and China plays a key role in manufacturing many of the ingredients and packaging materials the company uses. If McDonald's were to pull out of China or lose a significant part of its Chinese business, the company might have to adjust its supply chain. This shift could disrupt the global supply chain in the food industry, leading to a domino effect that impacts not just McDonald's suppliers, but also other companies that rely on the same networks. China's position as the world's factory means that a drop in business for McDonald's could affect a wide range of industries, from agriculture to packaging and logistics, causing a slowdown in production and a potential increase in costs for businesses worldwide. Another significant consequence would be job losses, not just within McDonald's itself, but also across related industries. McDonald's employs a large number of people in China, from restaurant workers to supply chain personnel. If McDonald's were to close down a significant portion of its stores or scale back operations, this would lead to direct job losses. But the problem doesn't stop there. McDonald's has an extensive supply chain, which includes everything from food suppliers to distributors, packaging companies, and logistics providers. Job cuts in the McDonald's sector could lead to a ripple effect in these industries, further exacerbating unemployment rates in China. The unemployment in the fast food industry could trickle down to other sectors that rely on McDonald's presence, potentially decreasing household income and purchasing power. A decrease in local consumer spending would not just affect McDonald's directly, but could also impact other businesses and the economy at large. China, with its growing middle class, is increasingly seen as a consumption-driven economy. The country is a major market for luxury goods, technology products, and, of course, fast food. McDonald's, as part of the global fast food movement, has created a new market segment in China that caters to the rising demand for quick, affordable meals with a Western twist. If McDonald's were to leave or see a substantial drop in patronage, the ripple effects would likely affect China's domestic economy. Chinese consumers might turn to other fast food chains or local alternatives, but the shift would still result in a disruption. The fast food industry, which has seen rapid growth in the country, could see a dip in overall sales. Many of the foreign brands operating in China, including McDonald's, have contributed to the diversification of the country's consumer landscape. A reduction in competition might limit choices for consumers, reducing overall satisfaction and economic diversity. On a more global scale, McDonald's exit from China could contribute to a decline in investor confidence. McDonald's is often seen as a bellwether for global trade and economic conditions, particularly when it comes to consumer goods. If McDonald's were to face challenges in China, it could signal to investors that the Chinese economy is less open to foreign businesses than they might have anticipated. It totally makes sense, right? This could lead to broader market uncertainty, with global stock markets experiencing volatility. For investors who have placed their bets on the continuing growth of China's economy, McDonald's struggle in the country could be an alarming sign of things to come. With less confidence in China's consumer market, businesses might scale back their investments or delay entering the Chinese market, slowing global trade and possibly affecting global economic growth. In conclusion, if China were to stop patronizing McDonald's, the effects would not be confined to just the fast food industry. McDonald's, being one of the largest and most iconic brands in the world, plays a significant role in global supply chains, employment, and international trade. A loss of business in China would not only hurt McDonald's bottom line, but could also result in job losses, disruptions in global trade, and diminished confidence in both the Chinese and global economies. Given China's crucial position in the world economy, a drop in McDonald's business there could set off a series of economic consequences that would affect industries far beyond the fast food sector, potentially leading to a decrease in global income and economic activity. For now, this prediction is still not happening in the next years, but it is not possible. Both companies remain one of the most loved and preferred go-to brands when hungry and when buying quality gadgets. Will Apple and McDo still make it to China for the next decades? Only time can tell. Thanks for watching.